Well, the market finished the session near the lows of the day, but I got to tell you, the action really was calmer than many of these instant moves on Fed Day that I've seen in the past. In fact, there wasn't any really fear, just your sort of typical knee-jerk selling. Investors, of course, don't like higher interest rates, but it speaks to strength in our economy. And if you look at the market overall, real estate, it was smoked. Home builders got hit under a lot of pressure, but the broader market taking a more of a wait-and-see approach. Consumer discretionary, by the way, was the best performing sector yet again. Now, after a solid 3 months of quiet gains, the market probably needs a catalyst here. Bringing in our panel to discuss, Keith Fitz-Gerald, Money Map Press chief strategist and former investment banker Carol Roth. Carol, first, the Federal Reserve, I've seen wilder reactions to the Fed in the past. So this was relatively calm. Some people got upset or nervous because we closed near the lows of the session. But what do you make overall? The Fed, merger mania, all these things that are starting to drive this market. Where are we going from here?
I think that from a Fed perspective, most of the sophisticated investors were looking at the 4 hikes, so I don't think that that was a surprise. And frankly, it's time for monetary policy to get out of the way. Focusing on economics, I think as long as we don't get another trade war or a scare in that direction, that is something that could really shake sentiment. I think that monetary policy is something that we're pretty set with, at least for the next, 6, 9, 12 months.
Keith?
I'm going to agree with Carol on that, but I'm also harshly critical of the Fed. I think their statement proves that they are once again behind the proverbial 8 ball. They're trying to play catch up, this idea that we're going to have symmetric inflation. And, that to me is a de facto admission that they are absolutely pursuing a model that doesn't work in an economy that doesn't reflect reality.
Explain that a little bit more, Keith.
Strong numbers.
Keith, explain that a little bit more for someone who's not as astute in the markets. In other words, what does that mean? The Fed doesn't understand what's going on with this economy, or they can't control what's going on?
A little of both, Charles. And again, I realize this is a very harsh statement, but here's the thing. The Fed was originally created to channel productive uses of credit in our economy. Back in the day, that was to industry, agriculture, and commerce, not to the Fed, not to the government, and certainly not to derivatives traders. If we look at where the Fed is today, they are using models that were largely architected based on the stuff that was going on 100 years ago in our economy. So what I'm saying in plain English is their models do not reflect the motion of the day, and they certainly do not reflect the role technology plays in today. So this notion that they're suddenly going to manage inflation, manage all these other things that their models don't reflect, to me, strikes me as preposterous. It's hanging on by the tips of their fingers and doing the best job they can. But again, I don't think they're in control by a long shot, and today's statement reinforced that in my mind.
Carol?
And they haven't been. I mean, the Fed cannot forecast their way out of a paper bag, and they have been very behind.
Exactly.
Frankly, the rate hikes that we're seeing now should have been happening years and years ago. And at this point, we are so far, even if they do 4 this year, if they do 3 next year, they're so far from a level that will really have meaningful impact on the economy. I think the biggest concern for, again, 12 or 18 months from now is that they just got it so wrong that they have to then accelerate, and that potentially could be a concern, but I don't think here in the short term.
Let me ask you about the potential merger mania, because rates are going up.
Yes.
We got a ruling from a federal court yesterday that seems to green light, vertical, horizontal, zigzag, it doesn't matter. And there's a lot of money sloshing around out there. Could we be on the cusp of something like that?
Absolutely. The happiest people in the world right now are investment bankers. They have canceled all of their summer plans. They are making pitch decks because, like you said, if you look from an antitrust perspective, that is now a more conservative stance than we have seen in the past. At the same time, when you have companies that are awash in cash because of the tax cuts and the repatriation, and also stock prices for some companies that are at all-time highs. So if they want to do a merger, it's a good time for them to use stock. So I think that you will see lots of different vertical mergers that we haven't seen before, and certainly very large mergers. And if you think about the implications of large, the increasing interest rates as well as large mergers, potentially could have a great effect on the financial sector.
Yeah, so
those bankers.
Investment bankers are happy, and the Murdochs are a little giddy too. All right, thanks a lot, guys. We'll see you again real soon.